There is a quiet signal moving through the global economy right now, one that hasn't dominated television headlines or flooded social media feeds, yet it may tell us more about the future of silver than the daily price chart ever could. Most investors are watching the price of silver. Institutional investors are watching policy. Because throughout financial history, the biggest moves in precious metals rarely begin with the metals themselves. They begin with shifts in government policy, changes in global trade, evolving supply chains, and the subtle decisions that alter how capital flows across the world. That is exactly why recent developments surrounding President Trump's trade agenda have captured the attention of economists, commodity analysts, and long-term investors alike. This isn't simply another political headline. It is part of a much larger story about strategic resources, economic security, and the changing relationship between governments and the commodities modern economies depend on. And silver happens to sit at the center of that story. By the end of this video, you'll understand why many experienced investors are paying close attention, not because they know exactly what will happen next, but because they recognize how today's policy decisions can shape tomorrow's markets. Before we begin, let me ask you something. Where are you watching from? And if you had to choose today, would you rather hold your savings in cash, gold, silver, or a diversified investment portfolio? Share your answer in the comments. It's always fascinating to see how different investors think during periods of economic uncertainty. Now, let's begin with the signal almost everyone else is overlooking. When most people hear about a new trade policy or tariff announcement, they assume it's a story about politics. But professional investors often see something very different. They ask a different question. What industries will this policy reshape over the next 5 or 10 years? That shift in perspective changes everything. Recent policy discussions around tariffs, critical minerals, and domestic manufacturing aren't occurring in isolation. They reflect a broader effort to strengthen supply chains that governments increasingly view as essential to national and economic security. Silver is one of those strategically important metals. Unlike gold, which is primarily held as a monetary asset and store of value, silver occupies two very different worlds at the same time. It has served as money throughout history, but it is also a critical industrial material used in solar panels, semiconductors, advanced electronics, medical equipment, and many emerging technologies. That unique combination makes silver unusually sensitive to changes in both investor sentiment and industrial demand. When confidence weakens, investors may buy silver alongside gold as a defensive asset. When manufacturing expands, industries consume more silver because they need it for production. Few commodities face these two powerful forces simultaneously. And that's what makes today's environment especially interesting. So what actually changed? The recent policy direction emphasizes increasing domestic production and reducing dependence on foreign supply chains for strategically important materials. While the exact implementation of trade measures can evolve over time, the broader message is clear: governments are paying much closer attention to critical resources than they were only a few years ago. Markets often react long before every policy detail becomes final. Why? Because markets don't simply price current conditions. They constantly attempt to price future expectations. If businesses believe obtaining key materials may become more expensive, more restricted, or strategically prioritized, they begin adjusting investment decisions today rather than waiting for tomorrow. That doesn't guarantee higher prices, but it does change the way investors evaluate long-term supply risks. For silver, whose market already balances both industrial demand and investment demand, even modest shifts in expectations can influence sentiment. This also explains why silver's behavior frequently differs from gold. At first glance, both metals often appear to move together. But beneath the surface, they're driven by different forces. Gold is primarily a monetary asset. Its demand is heavily influenced by central bank purchases, currency confidence, real interest rates, and global financial uncertainty. Silver shares some of those characteristics, but it also depends heavily on manufacturing activity. If demand for renewable energy technologies, electronics, or advanced industrial production grows, silver benefits in ways that gold simply does not. Conversely, if industrial activity slows significantly, silver can experience sharper declines than gold, even during periods when investors remain interested in precious metals. This dual identity explains why silver often experiences much larger price swings. It behaves partly like a monetary metal and partly like an industrial commodity. Understanding that distinction is essential because many investors assume silver should simply follow gold. History shows that rarely the complete picture. There's another layer many retail investors overlook. Institutional investors spend far less time asking, "Where is silver today?" Instead, they ask, What forces could influence silver over the next several years? That difference in thinking matters. Short-term traders often react to headlines. Long-term investors examine structural trends. They study government spending, manufacturing policy, energy transitions, supply chain resilience, technological demand, monetary policy, and geopolitical developments. Each individual headline may seem small. Together, they can reshape an entire market. This is why experienced investors often remain calm during periods of uncertainty. They're less interested in predicting tomorrow's price than in understanding the broader direction of economic change. And right now, several of those long-term forces appear to be converging. The question isn't whether every policy announcement will immediately transform silver prices. The more important question is whether the global economy is entering a period in which strategically important resources receive greater attention from governments, industries, and investors alike. If that trend continues, the implications could extend far beyond a single news cycle. Because once policy, industrial demand, and investor psychology begin reinforcing one another, markets can evolve in ways that aren't immediately obvious from the daily headlines. And that brings us to the deeper story, one that starts not with silver itself, but with the global economy, central banks, and the powerful macroeconomic forces shaping every major asset class today. To understand why silver has become the focus of so many conversations, we have to move beyond the headlines. Markets rarely change because of a single executive order, one Federal Reserve meeting, or one political speech. Those events matter, but they are often the visible surface of much deeper economic forces that have been building for months, or even years. Think of the global economy like an ocean. Headlines are the waves you can see every day. The macroeconomic forces underneath are the currents that determine where those waves eventually go. Serious investors spend far more time studying the currents than reacting to the waves. That is why recent discussions surrounding trade policy, strategic minerals, and industrial investment have attracted so much attention. Whether every proposed measure ultimately takes effect is almost secondary. What matters is the direction governments appear to be moving. Across much of the world, policymakers are placing greater emphasis on domestic manufacturing, resilient supply chains, and reducing dependence on critical imports. For investors, that shift represents a structural trend rather than a temporary news story. At the same time, another powerful force continues to influence every major asset class, monetary policy. For decades, the Federal Reserve has played a central role in shaping global financial conditions. Every decision regarding interest rates affects borrowing costs, business investment, consumer spending, and ultimately the value of the US dollar. Because precious metals do not generate interest or dividends, their relationship with interest rates has always been closely watched. Yet that relationship is often misunderstood. Many people assume that higher interest rates automatically hurt gold and silver, while lower rates automatically help them. History shows the reality is far more complex. What truly matters is not simply the interest rate announced by the central bank. It is the real interest rate, the return investors receive after accounting for inflation. Imagine a savings account earning 4% annually while inflation is running at 5%. On paper, your balance grows. In reality, your purchasing power declines because prices are rising faster than your money. Even though you're earning interest, you're effectively losing ground. This is why precious metals often attract attention during periods when investors question whether cash is preserving purchasing power. Gold has traditionally served as a monetary hedge, while silver occupies a unique position because it combines that monetary role with industrial demand. The value of the US dollar also enters this equation. A stronger dollar can make dollar-denominated commodities more expensive for international buyers. A weaker dollar can have the opposite effect. But currencies are influenced by many factors beyond interest rates alone. Fiscal policy, government debt, global capital flows, productivity, and geopolitical developments all contribute to long-term confidence in a currency. Rather than focusing on any single variable, institutional investors evaluate how these forces interact. They ask whether inflation is moderating, whether economic growth is accelerating or slowing, whether fiscal deficits are expanding, and how global capital is responding. Those questions often reveal more than any individual headline ever could. Trade policy adds another important layer. Modern economies depend on complex international supply chains that stretch across multiple continents. Raw materials may be mined in one country, refined in another, manufactured elsewhere, and finally assembled into finished products thousands of miles away. Silver is deeply embedded in that system. It is essential for electronics, solar technology, medical equipment, telecommunications, and many advanced manufacturing processes. Because of those applications, discussions about critical minerals are no longer viewed solely through an economic lens. Increasingly, they are also seen through the lens of national resilience and strategic security. Governments around the world have begun encouraging domestic production, investing in processing capacity, and strengthening partnerships with allied nations. These efforts are designed to reduce supply chain vulnerabilities that became more visible during recent global disruptions. For investors, these developments do not guarantee higher silver prices. However, they do suggest that strategic commodities may receive greater long-term attention than they did during previous decades. History reminds us that structural changes often unfold gradually before becoming obvious. One of the most significant monetary turning points occurred in 1971, when the United States ended the dollar's convertibility into gold. That decision fundamentally changed the international monetary system. Over the following decade, inflation accelerated, energy markets experienced major disruptions, and precious metals entered one of the strongest bull markets in modern history. The circumstances today are different. Today's economy is larger, more technologically advanced, and far more interconnected than it was in the 1970s. Yet one lesson remains remarkably consistent: markets respond when investors reassess confidence in currencies, inflation expectations, and long-term economic stability. Another useful comparison comes from the global financial crisis of 2008. During that period, investors initially rushed toward liquidity as financial markets experienced severe stress. Eventually, extraordinary monetary stimulus and historically low interest rates reshaped investment behavior across many asset classes, including precious metals. The lesson wasn't that history repeats exactly. It was that policy responses can influence markets for years after the initial crisis has passed. This is why experienced investors often resist making decisions based solely on today's headlines. They understand that major economic transitions develop over time, with countless smaller events contributing to a much larger narrative. Investor psychology plays an equally important role. Human beings naturally seek certainty during uncertain periods. When prices rise rapidly, many investors worry about missing out. When prices fall sharply, fear encourages selling precisely when emotions are strongest. These instincts are deeply rooted in human biology, but they rarely produce disciplined investment decisions. Institutional investors work hard to reduce emotional decision-making through structured research, diversified portfolios, and long-term planning. Rather than reacting to every market swing, they focus on probability, valuation, and risk management. That does not mean institutions are always correct. Markets remain unpredictable, and uncertainty is an unavoidable part of investing. But disciplined investors recognize that successful decision-making depends less on predicting the future with certainty and more on understanding the forces that are most likely to shape it. When viewed together, monetary policy, real interest rates, currency confidence, trade strategy, industrial demand, and investor psychology, a much clearer picture begins to emerge. Silver is not moving because of one announcement or one individual. It sits at the intersection of multiple long-term forces, each reinforcing or offsetting the others in complex ways. And that brings us to the final piece of the puzzle: what these converging trends could mean going forward, the different paths the market might take, and the lessons long-term investors can draw from history rather than emotion. After examining trade policy, monetary conditions, investor psychology, and the unique role silver plays in both industry and finance, one thing becomes clear. The future of silver is unlikely to be determined by a single headline, one executive order, or one Federal Reserve meeting. Instead, it will emerge from the interaction of multiple forces unfolding simultaneously. No one knows exactly how those forces will evolve, but we can think about them through a few plausible scenarios, not as predictions, but as frameworks for understanding risk. The first scenario is one of steady economic expansion. Inflation gradually cools, supply chains continue to stabilize, and investment in advanced manufacturing, renewable energy, and technology remains strong. In this environment, industrial demand for silver could remain healthy while financial markets stay relatively stable. Gold might continue to serve primarily as a portfolio diversifier, while silver's industrial role could become increasingly important. Investors in this scenario would likely pay close attention to manufacturing activity, business investment, and long-term demand rather than short-term market swings. The second scenario is one of persistent inflation combined with slower economic growth. This has historically been one of the most challenging environments for policymakers. Central banks must balance the need to control inflation against the risk of weakening economic activity. If investors become increasingly concerned about preserving purchasing power, precious metals have historically attracted greater attention. That does not guarantee rising prices, but it illustrates why many long-term investors monitor inflation expectations as closely as they monitor interest rates themselves. The third scenario involves heightened geopolitical uncertainty. Trade disputes, regional conflicts, or disruptions to global supply chains can increase market volatility. Strategic commodities may receive greater government attention as countries seek to strengthen domestic production and reduce dependence on vulnerable supply routes. In such periods, both industrial and monetary considerations can influence silver simultaneously, creating an environment that is often more volatile than gold. Notice something important about these scenarios. None of them depend on a single event. They are driven by broader economic conditions. That is exactly how institutional investors tend to think. Large pension funds, sovereign wealth funds, family offices, and professional asset managers rarely build investment strategies around one headline. Instead, they study long-term trends. They examine inflation data, employment reports, industrial production, corporate earnings, government borrowing, central bank communications, and global capital flows. They understand that markets are shaped by probabilities rather than certainties. Perhaps even more importantly, institutions spend as much time managing risk as they do pursuing returns. This mindset is often overlooked by retail investors. Many people focus on finding the perfect opportunity. Professional investors spend equal time asking a different question. What could go wrong? That question influences every decision they make. It determines position sizing, diversification, and how they respond when markets inevitably become volatile. The same principle applies to precious metals. Some investors view gold and silver primarily as long-term stores of value. Others see them as tactical allocations within a diversified portfolio. Still others focus on mining companies, exchange-traded funds, or futures markets, each carrying its own distinct opportunities and risks. There is no universally correct approach. Each depends on an investor's goals, time horizon, and tolerance for risk. History consistently demonstrates that emotional decisions often produce disappointing outcomes. During periods of rapid price appreciation, enthusiasm can encourage investors to chase momentum without fully considering valuation or volatility. During sharp declines, fear can lead people to abandon carefully planned strategies at precisely the wrong moment. The challenge is not eliminating emotion altogether. The challenge is recognizing it before it dictates our decisions. Behavioral finance has repeatedly shown that investors are susceptible to common biases. Confirmation bias encourages us to seek information that supports what we already believe. Loss aversion makes temporary declines feel more painful than equivalent gains feel rewarding. Herd behavior pushes us toward the comfort of following the crowd, even when the crowd may be reacting emotionally rather than rationally. Understanding these tendencies does not eliminate them, but it creates an opportunity to pause, reassess, and make decisions based on evidence rather than impulse. This may be the most valuable lesson hidden within today's discussion. Whether we are talking about silver, gold, stocks, bonds, or any other asset, successful investing is rarely about predicting the future with perfect accuracy. It is about building a disciplined process that can withstand uncertainty. Markets will continue to surprise us. Policies will change. Economic cycles will rise and fall. Technology will reshape industries. Geopolitical relationships will evolve. And through each of those changes, investors will face the same fundamental challenge they have faced for generations, separating temporary noise from meaningful long-term trends. That brings us back to where we started. The most important signal is often not the one dominating today's headlines. It is the quieter shift occurring beneath the surface. Trade policy, strategic resources, monetary conditions, industrial demand, and investor psychology are all interacting in ways that could shape financial markets for years to come. Understanding those relationships is far more valuable than trying to predict tomorrow's closing price. Because in the end, successful investing has never been about reacting faster than everyone else. It has been about understanding more deeply than everyone else. If today's documentary helped you see the bigger picture behind the headlines, consider subscribing for more evidence-based analysis of macroeconomics, precious metals, global trade, and long-term investing. These videos are not about sensational predictions. They are about understanding the forces that shape the world of finance so you can think more clearly, ask better questions, and make more informed decisions over time. Thank you for watching, and I'll see you in the next documentary.